Welcome back, everyone. Today on the Joseph Carlson Show. In the past 5 days, the S&P 500 has fallen 7.86%. This is a pretty big drop, but it's not nearly as concerning as the drop in Bitcoin, which over the same time period is down a staggering 27%. Now, there's lots of opinions on the subject of the Bitcoin collapse, but one of them I want to look at is the opinion of Michael Saylor, who was on CNBC this morning. He is, after all, the one that told everybody to mortgage their house and take out debt, mortgage their business to buy more Bitcoin. So we'll see if he has a moment of introspection, of reflection, or if he's still just as bullish on Bitcoin. We also have news today that President Biden wrote a letter to solve the oil crisis. This is what he's doing to solve the problem. He wrote a sternly worded letter that's saying your margins, your profit margins are, quote, not acceptable. And I actually want to take a look at this. I want to look at the actual margins and the profitability of ExxonMobil and see if it is in fact unacceptable. And then of course we have the big headline news of the day, which is the Federal Reserve increased interest rates by 0.75%, the biggest rate increase since 1994. And this caused a little bit of a market sell-off. And I want to explain in this video why I think the market here is wrong and why this should be looked at positively for investors. So as always, we have a lot to jump into in this episode. If you like this type of content, make sure you subscribe to the channel. Now, let's start off with a quick portfolio update. This is my portfolio. It is a real portfolio with real money that I show every single week. And after the past week of another aggressive sell-off in the market, I'm basically down to being flat. We've almost crossed back into the red. Just in the past 5 days, my portfolio has dropped 6.97%. That's another $23,000. Over the past month, it's down 4.47. Over the past 90 days, it's down 10.67%, which is $36,000. Now, I realize that when the stock market goes down in price, that becomes concerning, and many people become very scared to continually put money back into the market. They say that you should time the market, wait for things to bottom out, wait for things to improve. That's the attitude of most investors when the stock market starts to go down. And this has been proven over and over again by study after study. When stock prices go down, when companies' valuations become more attractive, when future expected returns are better, that's when investors stop buying. That's when they become concerned. That's when they either stop their deposits, they stop putting money in the market, or they simply take money out. They do the opposite of what they should be doing. Here's one study. Only 18% of Americans plan to increase their stock market investments this year. That's right. They say about 18% of Americans are willing to put more money in the stock market investment this year, including retirement accounts, according to a recent survey from Bankrate. The online survey polled more than 1,500 investors. So they looked at all these investors and asked how many are going to increase their deposits this year, and only 18% will increase their deposits this year over last year. And that doesn't logically make sense. Almost all of last year in 2021, the stocks were more expensive than they are right now. People were happy paying a higher price because stocks were moving up. And this is normal behavior. Even though it's not logical, this is what we do. When stocks start to move downwards, people get concerned. So my plan is to avoid doing that. I want to continue dollar cost averaging into the market. I'll be doing buys every single month with the companies that I think are the most attractive. I've been buying more Starbucks as the yield has gotten up to almost 3%. It has a very historically high yield. I've been buying more Target as this company's come down dramatically in price, and the yield is very high. I even added a little bit of Pepsi to my portfolio as this company's down nearly 10% in the past month. And this consumer staple should weather any storm in the future. I recently trimmed my position in Vici by $15,000 on June 6, and now the stock price has come down to, I think, a more reasonable valuation. It's down nearly 11%. So I've been buying more Vici. I'm building this position back up right to where it was before, and I'm getting a more attractive yield on it. And I've been buying more JP Morgan and T. Rowe Price. JP Morgan has almost a 3.5% forward yield. That is very high for this bank. And T. Rowe Price's dividend yield is above 4.5%. It's true that these companies will have probably slightly lower earnings during a recession, but they'll survive. T. Rowe Price, for example, has $2 billion in cash, and JP Morgan is still a highly profitable company. So I'm still buying company after company, buy after buy, every single week, and I'll continue to do that as far as this market goes down. At some point, this market will bottom, and nobody will be able to accurately call when the bottom is. But if you're buying every single month, you don't have to worry about when the bottom is. And right now, I am finding attractive deals on companies. So I do have a video coming out later this week where I'm going to go over 5 different companies and do a deep dive into their valuations, what I see in these companies, how they would weather any type of recession and increased interest rates, and why I'm buying these companies. So that'll be out later this week. I'll have more portfolio updates, but that's a little peek inside my portfolio and what I'm doing right now. Overall, I'm increasing the yield of my portfolio. I'm adding equity to it. I'm layering on more and more shares of discounted companies. Everyone knows that one of the overarching goals of my portfolio is to increase the amount of passive income I make. That is the name of the portfolio. And I track every single month how much dividend income I'm making. And I want this chart to go up as much as possible. Stock prices coming down for good dividend paying companies helps in this goal because they're not canceling their dividend. None of my companies have canceled their dividend. They're not lowering their dividend. What they are doing is offering a more attractive price to purchase more shares and increase the future yield of this portfolio. With Vici alone, with the amount of dividend raises they did, I'm going to be making over $1,700 a year from this company. And I'm not ending here. I'm going to continue to buy more of this company until it pays me over $2,000 a year from one company. And I want to do the same from Starbucks and JP Morgan and Texas Roadhouse, Microsoft and Apple and so on. I want these companies to pay me thousands of dollars a year in dividends. So don't become discouraged with the stock market right now. If you're investing responsibly, if you're dollar cost averaging in, if you're not leveraged, you're fine. You have time to work through this. I plan on building this portfolio up for at least the next 10 years. So I can wait out any type of recession or problem with the economy for a very long period of time. I'm in no rush. Now moving on to some news, we have Bitcoin's price going down 27% in just the past 5 days. That is a pretty significant move, even in the world of crypto, which is obviously more volatile. And year to date, Bitcoin's down 55%. Now this chart resembles a lot of the QQQ stocks, specifically the smaller, unprofitable tech companies, the Peloton type of companies, right? They went up like crazy during the pandemic, and then over the past year, they've come crashing down. Now, Bitcoin is even more of a high-flying, volatile asset than many of those companies. Over the past 5 years, it's still up 700%. And then if we zoom out even further, of course, it's up a lot. It's up over 6,000%. Anyone who bought Bitcoin and held on to it before 2017 became very wealthy. Now, I'm not trying to kick Bitcoin when it's down. That's not the goal of this. I've had lots of companies in my portfolio drop 25 to 30% in a single day. Target dropped this much of all companies in a single day. Remember when Target dropped 30% in one day? So it's difficult to point fingers in this market, and that's not what I plan on doing. But even in the class of crypto, there is a responsible form of investing and a very irresponsible form of investing. On the subject of irresponsible investing, we have Michael Saylor of MicroStrategy. He is probably the most notable Bitcoin bull. He's someone that leveraged his firm to a huge degree to buy as much Bitcoin as possible, and he encouraged others to do the same thing. Now, with this sell-off, he was asked about the strategy and the flexibility of Bitcoin. Here's his response.
No, I think it's been a net positive. We back tested our strategy against every other alternative. And if you roll the clock back to August 10th of 2020, when we embarked on this journey, Bitcoin's performed 10x better than anything else. Gold's down 10%, NASDAQ is flat, Bitcoin is up 86% since that time. Over any time frame, 2 years, 4 years, 8 years, Bitcoin's the best performing asset. I can't come up with a better idea.
He says that he can't come up with a better idea and that Bitcoin is the best performing asset over the time period that he listed. Now, I think that is true, that Bitcoin is the best performing asset over the given time period, but you can't look at past returns of something and just extrapolate that it's going to continue to have those returns. If you invested in Bitcoin back in 2017, you did really well. But if you invested in it at the beginning of 2022, you lost half your money so far. So obviously when you invested and at what price is an important part of this, and he doesn't seem to get that. Now, Michael Saylor, like a value investor, goes on to explain how important time is. You have to be long-term focused. That's what we hear from value investors over and over again.
Yeah, I think if you think about Bitcoin, if your time horizon is 1 month, it looks like a volatile risk asset. But if your time horizon is 10 years, it looks like a risk-off store of value asset. So the crossover point is 4 years. Nobody's ever lost money investing in Bitcoin for 4 years.
That's the big timeline that he focuses on, a 4-year time period. And he says that nobody's ever lost money in Bitcoin in 4 years. Bitcoin started to trade around 2009. So even though that's technically true, everybody's made money over a 4-year period, it's really not a long time period. This is really all short-term stuff here.
And if you want a surrogate for the book value of the Bitcoin network, it would be the 4-year simple moving average. The simple moving average of Bitcoin over 4 years is about $21,685. Bitcoin's only touched that point a couple of times in its history, and those have always been great buying opportunities. Right. This is all right. Bitcoin's on sale.
We're touching that. We're touching that price right now. It's funny.
Now, right now, Bitcoin is at that price, that 4-year moving average price. So Michael Saylor thinks it's a good time to buy.
So is it a great buying opportunity?
Absolutely. Bitcoin's backed by the most powerful secure computer network in the world. If I gave you $100 billion, you can't reproduce it. And it's beyond a nation state attack or corporate attack. So once you understand that, and the fact that it's a singularity, there's nothing like it in the world, then yeah, this is an ideal entry point to get into this thing.
So he thinks it's a good point to get into Bitcoin, and I'm not even arguing against him. Maybe it is. I don't know. But what I will say is that this same person, Michael Saylor, this same person in April of 2021 said that this was a good time to buy.
But take all your money, buy Bitcoin, then take all your time, figure out how to borrow more money to buy more Bitcoin, then take all your time and figure out what you can sell to buy Bitcoin. And if you absolutely love the thing that you don't want to sell it, go mortgage your house and buy Bitcoin with it. And if you've got a business that you love because your family works for the business, it's in your family for 37 years, and you can't bear to sell it, mortgage it, finance it, and convert the proceeds into the hardest money on earth, which is Bitcoin.
He was telling people to mortgage their houses and to mortgage their businesses and to tell the business they work for to put all the money in Bitcoin. April 16th, Bitcoin's down 64% since then. I see it as one thing to have a certain percentage of your portfolio in crypto, like 2 to 3%, but it's an entirely different thing to instruct people, retail investors, to mortgage every part of their lives, their business, their home, everything they own to buy Bitcoin at $60,000. This is what he was doing just a few months ago, and he was doing the same thing with his business.
If you had a chance to grab $2 billion at 1.5% interest, it seems like a reasonable thing to do, and I'm glad we did it. Most of it is unsecured debt. 1.7 billion of it is unsecured. The 500 million comes due in 7 years after we borrowed the money. So we feel like we have a fortress balance sheet. We're comfortable, and the margin loan is well managed.
From the sounds of it, it looks like he got really cheap debt, cheap interest with almost no covenants, which will protect him to some degree if Bitcoin continues to fall. But at some point, he will be margin called and lose money that he doesn't have because of this debt. Anytime you take loan money to invest, you run the risk of being margin called. Right now, for example, I could take out $125,000 of margin just from M1 Finance, and I could put that in the stock market. Now, the reason that I don't do that is because I think it's irresponsible. I don't think Michael Saylor should be telling people to mortgage their house, mortgage their business, and buy as much of the most speculative, most volatile assets that exist in the market. I don't think that's responsible to do. And even though my portfolio might go up and down in value over the next 3 or 4 years, I never have to worry about being margin called. That's never something that's going to be concerning to me. So I can, without any type of stress, just hold on to these companies for the next 5 years with no issues. Now, moving on, we have the big solution from President Biden on how to solve this oil crisis, how to bring down these ridiculously high prices. Oil across the country is above $5 a gallon. That's the average. In some places, it's a lot more in like California and other places. And President Biden has the solution. What he's done is he's written a sternly worded letter to all the oil companies. Very sternly worded, and he's rebuked them. He's scolded them. Like a parent scolding a child for doing something naughty. I think in some of them, he actually used the oil company's middle name. He says in the letter, quote, "At a time of war, historically high refinery profit margins being passed directly onto American families is not acceptable." That's unacceptable. Your behavior, ExxonMobil and Chevron, what you've done here is just unacceptable. We don't do that in our country. That's not what we stand for. This isn't the American way to charge money for a product based on supply and demand. I mean, that is the entire way our economy is set up, but this is unacceptable because I don't like that it's hurting my polling in the polls. I don't like that this is making me less popular. He goes on and says, quote, "Companies must take immediate actions to increase the supply of gasoline, diesel, and other refined products." Now, I would agree with that. Maybe these companies can increase the supply of gasoline and oil. Maybe that's something they'll do. Now, Biden goes on to the core of this subject. These oil companies are simply too profitable. They're making too much money. He doesn't like how much money they're making. Quote, "Since the beginning of this year, refiners' margins for refining gasoline and diesel have tripled and are currently at the highest levels ever recorded. So he's saying that it's just unprecedented how much money these companies are making, and their margins are far too high. Now, I didn't know it was the role and responsibility of the president and the administration to determine what is an acceptable and unacceptable level of margin for companies. Maybe he can spell that out. Maybe, this level of gross margin is okay, but above that it's not okay. This level of profit margin is okay, but below that it's not okay. What is the guideline there? In fact, we can look at ExxonMobil and get a better idea of what President Biden is saying are unacceptable profits and margins. Let's go ahead and use Qualtrim Insights. This is available to all Patreon members. And by the way, we had a huge update on this. Now let's go ahead and flip over to annual here to get this more clear. Let's pull up the free cash flow because this is, after all, the big indicator of how much money these companies are making. ExxonMobil's free cash flow over the years is very volatile. This is a reason that this company trades at typically a lower multiple than other companies. Some years it's very good, some years it's very bad. And last year, 2021, this is in fact a great year. President Biden is correct. They made $36 billion in free cash flow. That is dramatic. But if we just rewind one more year, in 2020, they lost $2.6 billion. Now, that seems interesting. They went from a huge loss in $2.6 billion, losing money, to being profitable $36 billion. If we also look at the net income here, this paints a similar picture. $23 billion in net income. Then in 2020, they had minus $22 billion in net income. That was a pretty bad year. Now, I don't remember President Biden coming out and saying that their negative profit margins during 2020 were unacceptable. Apparently, it's only unacceptable when they make too much money. We added in a new chart here that actually shows the profit margins, and you can see that in 2020, all the margins went down dramatically. The profit margin in 2020 for ExxonMobil was minus 13% at one point. That is really low. They were losing a lot of money. And I didn't at this point in time hear the president complaining that one of America's great businesses is losing money. It seems that this has only become a problem as they become profitable, not when they're losing money. And he says that he wants to work with the oil companies. The crunch the families are facing deserves immediate action. Your companies need to work with my administration to bring forward concrete near-term solutions that address the crisis. So that's President Biden's solution here, to write that sternly worded letter, to say that what they're doing is unacceptable, it's un-American, they should be making less money, and they shouldn't charge what supply and demand dictates that they're charging. Now, the oil industry actually responded to President Biden's letter. This is from the American Petroleum Institute. They say, quote, "While we appreciate the opportunity to open increased dialogue with the White House, the administration's misguided policy agenda, shifting away from domestic oil and natural gas, have compounded inflationary pressures and added headwinds to companies' daily efforts to meet growing energy needs while reducing emissions." So they're painting a bit different of a picture here. They're saying, hey, look, President Biden, this is actually a result of your administration's misguided policy on driving away domestic oil and natural gas. That's contributed to the issue. Then they go on to outline 10 steps the administration and Congress should take to tackle the energy crisis, including lifting development restrictions on federal lands and water and accelerating LNG exports. So in summary, the energy industry is saying these are specific steps that could be taken to resolve this issue. We could open up these restrictions that have been making it so we can't drill and produce as much as possible. And President Biden's solution is to say, look, just charge less, just make less money. It'd be really nice if you didn't make as much profits and had as high as margins as you do. So there we have two different takes on the issue. Now we have some big news to get into of the Federal Reserve raising interest rates. Before we jump into this, we have to give a shout out to our sponsor. It's FTX US. They're known as one of the largest US regulated crypto exchanges with over 1 million users. They sponsored many people you probably heard of like Tom Brady, Kevin O'Leary, Steph Curry, and so on. Now, even though FTX is mostly known by people as a cryptocurrency exchange, and they do allow you to trade all the cryptocurrencies with minimal fees, that's not something that I've been using them for. In fact, you know my views on cryptocurrencies. I don't really buy things that I consider to be not cash flow producing assets. So I'm not buying Bitcoin or Ethereum or anything like that. I know people that do, but it's just not something I'm very interested in. Now, one thing that FTX wants people to be more aware of is that they're moving into other verticals. One of them is stocks. And this is something that's interesting to me. They are opening up a new stock trading platform that is very simple and easy to use. You can go in, type in a ticker symbol, You can buy or sell anytime the market's open with fractional shares. And there's no fees and there's no payment for order flow, so you don't have to worry about that as well. Now, currently the stock portion is in beta. They have thousands of people testing it, and I've just been testing this out buying more Amazon. Currently I have 6 shares, but they're going to be opening this up to more people in just the coming weeks. So if you want to sign up for an account, it's completely free. It takes 2 minutes to sign up. There's a link in the pinned comment for the web version or the mobile. Either of them work. And when you sign up, use the refer code Carlson, my last name. That not only lets them know that I sent you, which helps support the channel, but it also credits you $10 when you deposit $100. Now back to the video, we have the big news that the Federal Reserve increased interest rates by 75 basis points. That is 0.75 percentage points. Now, a week ago, just 1 week ago, they were expected to raise it by 0.5%. But then that inflation report came out and changed their view on it. Inflation came out well above expectations, and that put more pressure on the Fed. They needed to show that they're taking this inflation seriously. So what we know so far is that this is the largest increase in interest rates since 1994, and it puts the overall federal funds benchmark rate between a range of 1.5% and 1.75%. Now here's the interesting thing. Right when this happened, right when the Fed announced the 0.75 percentage point increase, the stock market across the board went down like 0.5% to a full percent. So investors were acting like this wasn't priced in, like they weren't ready for this, and maybe the Fed would do a 0.5 percentage point. And I think that this is the wrong reaction. I think the market has this wrong. I think it's much better for the long-term investor that the Fed takes this aggressive stance and gets inflation under control. I think the most damaging thing to our portfolios in the long run is sustained, heightened inflation. Not the federal funds rate going up temporary, but inflation. So even though the market right now is trying to make sense of this and there's this little sell-off, I think this is overall positive news. Inflation needs to come down. That's better for long-term investors. It's better for the stock market overall. And the quicker we can do this, the better. So I think this little sell-off on the Fed increasing interest rates by 75 basis points is unwarranted. Investors should look at this as a positive thing. It means that inflation expectations should be taken lower. And right now, out of all the challenges we're facing, inflation is by far the most difficult for the stock market. And I think that there's a decent chance, there's a good chance that if we do get inflation under control by the end of this year, if we lower it down to 4% to 3%, that the stock market will turn far more bullish. So that's my thoughts on it. Either way, I'm going to continue buying into the stock market, and I'll have another video laying out in detail what my plans are with my buys. I have 5 different companies I'm looking at, and I'm going to be doing in-depth analysis on each one of them. So subscribe to the channel if you haven't already, and I'll see you later this week.